Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. And guys, we have a very special guest on today. I'm very humbled to have her on, talking a lot about everything that's going on in the macroeconomy, but really diving deep into the secondary market and what's going on and why it's heating up. She has facilitated almost $10 billion worth of transactions in the mid and late stage private companies, working very closely with 100 private companies, some including Slack, Uber, Stitch Fix, and PagerDuty. She is currently the general partner at incredible Manhattan Venture Partners. And we're so excited about having her on because obviously she's worked with a lot of multifamily offices in this industry, but helping them also navigate what's going on as the macro economy changes, whether it was obviously 2023 and hitting 2024 and beyond. So we're excited about having her on. Please welcome my next guest, the one and only Andrea Lamari. How you doing today, Andrea?
I'm so good, Christian. Thanks so much for having me. I'm really excited for the discussion.
Well, I'm excited having you on because obviously one of the things that I found so interesting, we're kind of leaving out of 2023. We saw a massive decrease in valuations in this late stage companies. And though that gave an amazing arbitrage and amazing opportunities, but for a while it was stagnant, and mainly because the buy side and the sell side, it was differentiated. Some people wanted $100 per share, whatever it was, and now the valuation decreased and it's like 20 cents on the dollar and so forth. And so what we're noticing though is now we're kind of seeing it leveling off. And I want to just ask you, with working with so many family offices and ultra high net worth, what are you noticing in regards to the industry right now? How these individuals are navigating this industry to make sure that they're taking advantage of this opportunity?
So it's a really, interesting time, right? Because as you said, valuations leveling off. And overall, I think everyone's just, kind of considering, right? Are we at the bottom of a trough? Are we on the way up? Where do we see these companies growing from here? And overall, I think the general question is, are the companies that are so large, are they really too big to fail? Or is there a world where even if they hit every metric in the book that is traditionally sought after in growth and late stage companies, and even if they hit that, profitability line and go above the line with single digit or greater profitability metrics, you know, is there still a world where there could be a downside risk, right? And when investors and families are assessing these opportunities, I would say generally the big question is this an asset that still seeks the level of return potential that gives the end investor, being either a family office or otherwise, the level of comfort they have on the level and side of duration of holding the asset that makes the most sense relative to the general composition of your investment portfolio. And when it comes to these companies, right, many of them do have traditional characteristics that make them fundamentally good companies. But I would say one of the biggest concepts that I'm discussing with many of the family offices, of which at my firm we have over 600 family offices that have deployed capital with us across our 4 venture funds and over 100 managed co-investment vehicles, which is quite substantial. We ask them, when you're assessing one of these growth and late stage assets, is the company providing a product, a service, or a platform that is considered a need to have versus a nice to have, right? Because the products and services that are need to have, that are fundamentally companies that provide infrastructure, that provide mission critical components of either B2B businesses or B2C businesses and consumers, or is it simply just a nice tack on to a traditional budget, right? When it comes to the enterprise spend or consumer discretionary spend, right? So that need to have versus nice to have, if there's just one concept I would take away here, it is that one.
So I love what you said there, specifically about the need and the nice, because what I noticed definitely with AI integration, we're seeing a lot of these software companies basically becoming obsolete very quickly because AI can be more efficient, more effective, and so forth. I was just even reading an article about how a lot of copywriters are actually losing their job, for the chat GPT. And that's just a good example of really making sure that you have a defensible moat and also navigating those right partnerships and relationships and co-investment direct deals with your family offices. When you're looking at this, I would imagine definitely in the later stage, I'm a big believer in making sure like we're seeing amazing opportunities to deploy capital. However, though, a lot of individuals are worried that they want to make sure that they're not catching a falling knife. So I'd love for you to just kind of talk about how Manhattan Ventures, you guys are able to properly do due diligence and underwriting, and even maybe just working with your family offices and helping them navigate the right deals versus deploying capital. Maybe you might get something a good deal, maybe it might be 10%, 10 cents on the dollar, etc. However, though, you want to make sure you're not catching a falling knife. So I'd love for you to just talk a little bit about that.
Sure. So I love what you said there, right? Because so much of the concept of diversification and asset allocation strategies across venture and really for us is the opportunity at hand, is that investment at hand, the right deal for the right time in the market, and is right now the right time in the market, right? With that being said, generally, where we, I think, have a really strong position at Manhattan Venture Partners is because we have always, for the last 10 years of our existence, actually, been known as predominantly a secondary principal investor. And what does that mean, right? Christian, as you said it, we typically are investing in companies, by way of predominantly a focus on investing in the secondary stock, which is the stock that's been issued to the investors, to the early employees, to the founders. We're buying that stock from them as our predominant investment focus and thesis. And then what we're doing is investing in the next rounds of funding subsequently if those opportunities are also realistic and are also appropriate for our investment thesis. So we do like to say that our primary business is secondary and our secondary business is primary, and the primary being the new rounds of funding. So with that said, and that being our real core thesis as a fund over the last decade, we believe that just based on the data sets that we have, and I think what's really awesome is we have this really data rich data poll that we do, which combines all of the sources of the bid and ask offers of the secondary market, right? And Christian, there's no like stock exchange, right, for the secondary market. It's something that over my career, after being at Carta and NASDAQ Private Market and Forge Global and building infrastructure for these marketplaces, we've tried to consider what a stock exchange for private company stock would look like. But fundamentally, there's just so many amazing functions that a private company reserves by staying private. And a lot of that means picking who their investors are to join the cap table, allowing their board to have a say in who those investors are, a right of first refusal, which is the company's right to block proposed investments or secondary transactions. All of these things we at MVP really honor with private companies. We understand that's why they're private. They don't want just anyone buying and selling into their stock. So they have policies and procedures to allow them to reserve that right. And we reflect that in our thesis. And with that said, we're looking at all these data points. Like we believe that on any given day, I actually do see somewhat of like a stock ticker that hits our data product internally that we've built. It's not a product we release publicly, but we do bring that insight to our LP base of our funds. And we understand where effectively private markets companies are trading in not a stock exchange, but at least an order book in a sense. So we're pulling in all these data points from other platforms, emails, conversations, and it's really data rich product. So I mention that because we use that when we're defining our thesis about whether or not we invest principally in a company to say, is this entry price the right entry price to achieve the opportunity that we want and the threshold that we want? And then we're going in and we're typically saying we're actually selecting many of the companies up front, and we're actually choosing an entry price that we feel comfortable with as a way to hit our investment hurdle. And so we do that and we share those insights with our LPs. And I would say that is what is fundamentally, I think, a strong position that all of us, right? Family offices, venture funds, if you have a desired entry price in a company based on an investment thesis you've developed, right now is a buyer's market. So you could go to a shareholder base and say, hey, we've developed a thesis, we have capital ready to deploy. Here's the price we're willing to pay. And in today's market, generally, many shareholders are quite receptive to that because there is a liquidity crunch and people are willing to play ball when people have actual capital they're ready to deploy.
Beautiful analysis there. And I want to dive in a little bit deeper, Andrea, if you will. When you're looking at, let's imagine, ABC company, the market right now, holistically with your data and, in-house, you're noticing it's trading at $33 per share. Let's just say for example, do you
Hmm.
put in a bid price to say, okay, well, we want to hit XYZ return for ourselves and our investors. So in order to do that, we have to basically get about $25. Okay. Do you put a
Yep.
bid in for $25 and let it sit there for a few months until someone obviously pulls the trigger and says, "Hey, I'll accept the 25?" And then my second question on that is I do know, like you mentioned, in this private market, in the secondary market specifically, there are inefficiencies. So sometimes you have, $1 million tranche and then a $10 million tranche and then a $3 million tranche, all structured differently. And sometimes even bigger slabs, $25 million tranche. But obviously, you got to really navigate that and you got to pull the trigger very quickly in order to obviously take advantage of it. So I'd love for you to talk about both of those and how you are able to work with your family offices to make sure that not only are you able to be efficient and look at the bid pricing as well as making sure you're hitting those returns, but also facilitating in a quick formulated capacity.
It's very, very strong to be able to say that you have, yeah, that capital ready to deploy, right? And I would say what's really fascinating, as I describe the data rich environment that we sit in, at the center of the market, is that ultimately, what really typically isn't being reported, and there are certain channels of which the data is there, but the data that the general secondary market and those of us who are active participants in it can see is that order book. It's the bids and the asks. What we're typically not getting the received information on, and there are a lot of confidentiality reasons around why this is generally not available, is I don't actually see the settled trade data. So, what does that mean? I see the bids and the ask, but I'm not necessarily seeing where it actually settled, closed, and was affected. And overall, what that means is that I might see a bunch of bids and I might see a bunch of asks, right? Well, if ultimately there's just a bunch of supply out there at an ask and it's really not clearing at the bids, it means there's too much of a spread there and we need to narrow that spread. And ultimately, at the end of the day, the buyer is the one who sets the ultimate closing price because that's the price they're willing to pay, right? And so, I do see that there's a lot of activity where people are simply lodging indications of an ask or a bid out into the market, and that's what lands into these order books. But if you do have that capital and you say, hey, listen, Christian, in your example, maybe the market of the ask is at 33, you're willing to pay 25, so you're down there at like a 30+% discount to that ask price. Ultimately, unless you're seeing a lot of that supply clear at 33 and instead it's just, kind of aggregating and there's a bunch more supply than there is demand, well, then the market really isn't at 33. The market is where the market clears. So I think that, I am never a proponent generally, right, without some, extreme circumstances to propose that any one investor has their capital sit there for a long period of time, right? Because that's a cost of capital and opportunity cost. And if you say, hey, if I'm just going to have my $25 bid sit there for 2 or 3 months, well, then you're tying up that capital for that duration. So instead, I think it is a really strong function if you're a family office or your family office that is working directly with someone who's working as an agent, a broker, or maybe you're working with a general partner manager that you've deployed capital into, who is also then someone like a Manhattan Venture Partners, where we're then deploying capital on your behalf. Just put a duration out there, right? Is it a limit order? Is it a limit order that says it's good till when, right? Is it a week? Is it 2 weeks? Is it you could actually do this in the market today. And it's really different today than it was in 2021, going into the tail end of 21, because back then sellers of these positions could just sit there a long time and just drag it out. But there is a lot to say around actionability and having real dry powder. And with that being said, I think it's better to just say where your entry is, and if you're ready to move on it as a buyer of these stocks, then go for it at the lower bid. Why not?
Yeah, Andrea, and you're saying some beautiful stuff in regards to sellers are hitting reality very hard in this
Yes.
situation, but buyers, it is a beautiful situation. And I'm curious also because I remember specifically, I had the opportunity um, when I was working with a VC firm. You and I know this VC firm very well, and they're very close relation to certain companies that I deploy capital in, SpaceX and Stripe. And what was interesting is they helped me navigate and do proper due diligence and underwriting. So I really leveraged their expertise and experience and so forth to make me feel comfortable when I was deploying capital. And I think that's just so important because I was working with another broker dealer actually, and they gave me some access to Databricks. However, though, and there was great structure, but they didn't have access to the due diligence and the underwriting and so forth. And so it was more of just like, well, I don't want to deploy capital. And I know that that's been one big thing that um, a lot of family offices, it's top of mind for me. I think that's one of the reasons why people gravitate toward obviously Manhattan Ventures and so forth, Manhattan Partners, because you guys are able to facilitate that and you guys are able to bring proper due diligence. Now, what is interesting also is you guys structure it in regards to a fund where you get exposure to numerous as well as direct. And you just mentioned co-investing and so forth. I'm just curious on a holistic. I've heard different perspectives on this. Are you noticing, family offices used to be really, really active toward funds and they were fine with
Mhm.
taking kind of the fee structure and they were fine with that because they were relying on the team's experience and expertise. But now I'm noticing a little bit more trajectory and kind of trend toward more co-investing direct deals. But again, they don't have the in-house ability. Some of these smaller, family offices, single family offices, don't have the in-house ability to do the underwriting, to do the due diligence. So I'm just curious, like, what are you noticing in regards to that trend overall, and what that perspective is?
Yeah, so I think this is one of my favorite questions I've been asked, and I appreciate your insight into it because you've obviously had the experience yourself, and then you taking a look at the Manhattan Venture Partners perspective. Overall, our responsibility as a fiduciary investor is twofold, right? We're doing the best for the company, and we're doing the underlying issuer, I should say, right? That startup, and then we're doing the best for our investor base. But at the end of the day, we ourselves at MVP are principal investors ourselves, and we have an investment thesis that we have to hit. So, on a case by case basis, what we're evaluating when we're working with one of our family offices who wants exposure to a company is a few fold, right? We're saying, what is your entry price? What is your entry check size you're looking to deploy? What is our relationship with the underlying issuer and the expectations that we have set with that issuer? And what is the responsibility that we have principally on a fiduciary basis to say, is this an asset we already own, we've already invested in, we want to invest in, or something along the like? And with that being said, I will tell you in many instances, what we do, and I think a strong venture manager is responsible for doing, is saying, is this asset better served with some shareholder on the cap table that is us, or is it someone else? And when I say that, Christian, I think what makes a really compelling, very deep relationship build with you and your investors, whether that's me and my family offices or another venture manager and their limited partners, you know, is there something strategic in nature about either me as MVP investing in the asset directly, me spinning up a co-investment vehicle or using an existing co-investment vehicle that we already have that's been invested in that asset, or am I positioning this family office or this LP into the company directly for strategic reasons, capital reasons, ongoing follow on investment reasons? And there are certain examples where we have where, we very much so said, hey, we're going to take a back seat because perhaps this asset and the entry price and the opportunity just really isn't going to fit my investment mandate, right? And instead, what we'll do is because that family office wants to be directly involved in the company, then we're going to walk them in the front door to the best capabilities we can so that they can have a direct seat and a chance to then work with the company directly and deploy capital. And I'll tell you, one of my best examples of this is there's a top four big box retailer that everyone in the world would know the name of that wanted to consider a direct investment, and it was the family office of the retailer and into a supply chain and logistics late stage private company. And we at MVP ran our investment models. We actually provided those models, the waterfall model, the sensitivity model, the financial analysis. We provided that to the family office. And we said, listen, at the end of the day, we ourselves don't feel as though this asset fits our thesis. But as we thought about the strategic nature of what that family office could provide to that logistics company, we said, let's just bring it through the front door. So we set up a series of meetings with the CFO and the extended team there. And it led to a really prosperous relationship that I think landed some pretty big considerations around a commercial contract with that retailer and the issuer. So then, that's our job. And then at the end of the day, if that family office says, thanks guys, that's so amazing, we just hope that that then builds that reputation and relationship between us, the issuer, and that family office ongoingly.
Incredible, incredible. You are working alongside each one of these LPs or family office that you work very closely with, and you may be the intro. You may be finding the mutual synergies to ensure that the obviously holistic kind of business partnership takes off. And again, MVP itself may not deploy or actively, negotiate in that kind of structure regarding deploying capital, but you guys are obviously facilitating the relationship of that, which is really cool. I want to ask you, just pivoting slightly, because I know we talked a lot about secondaries and so forth, but one of the things I always found interesting is, the VC. But I want to ask, before we dive into the VC kind of ecosystem, I want to talk specifically about liquidity, because what I'm noticing also is, top of mind for a lot of investors, they've been illiquid for some of these
Right.
investments for a period of time, right? VC a
Hmm.
little longer than expected. You also have private equity a little longer in some of the funds. And so I'm curious, when you're working with a lot of your family offices, what are you noticing in regards to just their kind of their flavor, if you will, their taste
Hmm.
for liquidity? Because I do know secondary
Hmm.
market, you can exit pretty quickly compared to obviously a VC, which may take 7, 10 year kind of fund structure, where,
Hmm.
obviously secondary and pre-IPO companies, you're talking maybe 2, 3, maybe even 4 years in regards to kind of having that exit. How important is that for a lot of your LPs you're noticing, and why you guys are noticing that this is kind of such an attractive class specifically for liquidity purposes?
I will say the big shift in thematic consideration, I would say, across growth and late stage investors, both traditional venture capital investors as well as crossover investors that might take the shape of, hedge fund managers, multi asset managers, private equity guys who might invest in late stage or growth stage venture and then continue holding their position post IPO exit, and then furthermore have strategies to build or hedge against their positions alongside others in the public market. And I would say that thematic consideration in terms of the metric that is really being asked for amongst venture as an asset class today is completely based on DPI, which is distributed to paid in capital, which is really the measure of how much capital an investment firm has returned back to their investors, right? Having strong ability to say you've returned a 2, 3, 4, 5 and above exit multiple on your paid in capital is a really strong consideration. And I would say generally DPI has always been that metric that has been one of several that VCs have been measured against alongside IRR and TVPI and MOIC. But overall, that DPI in terms of just raw paid in capital return is what I think LPs are asking their investors, their end managers to focus on heavily. And with that said, DPI is a hard metric to achieve if you're an early stage fund or an emerging manager, because you might be, as you said, Christian, 5, 10 years away from an exit. But all of us that are, investing in the late stage and with MVP, we traditionally look to a time horizon to about 2 to 4 years from the point of our initial investment to that hopeful expected exit, right? That's what we underwrite against. Overall, that is where the LPs are saying, show us what you did in your vintages, your DPI. Where did that actually land? And that's probably one of the first questions we get when we're having conversations with LPs in today's environment, and it's a very fair ask. And so that track record's important. And generally, I'll tell you, IRR, whether it's on a net basis, gross basis, uh, the problem with that now is, instead of that being the hot metric to measure against and benchmark against, is that that's typically been on the basis of a company's valuation, right? Their last private mark valuation of where they raise capital at. But because, valuations might be tremendously high, and then, relatively now, from an audit perspective, those valuations have come down significantly. IRR isn't necessarily the metric that holds the most weight these days when it comes to LP considerations. So I even know, I'll tell you, Christian, I've been hearing of certain large growth stage funds that have actually hired dedicated teams now internally, simply on the basis of saying your one job is to generate DPI across the fund. So they're looking for exit strategies. They're looking for liquidity. They're considering secondary. They're considering how to help companies be in a position to prepare themselves for some form of exit, whether it's a strategic acquisition, a merger, plan for the IPO. But those DPI teams are something I've just heard of recently as being spun up as a strategic component of certain funds.
Wow. So this is actually interesting. I appreciate bringing this up. So you're instead of
Mhm.
optimizing for the IRR, which is what was normally, now you're seeing kind of just a whole industry pivot toward the DPI, and because of just what you mentioned in regards to kind of the inefficiency. Interesting. Interesting. Do you feel like by optimizing for the DPI would, as an investor, would be
Mhm.
beneficial? Do you see that long term, or what is your perspective? Or do you think the IRR is still kind of a premium kind of metric to focus on?
Well, I think IRR, depending on where the manager marks their IRR, right? And I think that's a really fair question in terms of what LPs, family offices, should feel comfortable asking as part of their diligence process with managers they might be evaluating is how do you measure IRR on a net basis and a gross basis? And how do you benchmark that against other funds of your category in the asset class? And so, at MVP, we have, I don't think we take a traditional route. I think we actually take a quite a conservative route with how we measure IRR because we're realistically evaluating where these private companies are actually, I would say, trading, or where there's a market clearing price that we're actually aware of in the market. And that might actually be different relative to their last round of valuation. So we're using a few different measures when we actually measure our IRR, and we disclose that very wholeheartedly to our LPs to say, hey, listen, I don't know if we generally believe that we should always use the basis of a last round of funding as the mark to measure IRR against, right? But of course, if the company just closed a new primary round, right? They raised some big fat round of funding in the late stage and it was a clean round. And what does that mean, right? It was a traditional round, nothing funky, no debt covenants, nothing with crazy hurdles or something else. Well, you know what? That's a pretty fair mark if that closed recently as a new round of funding. But otherwise, we ourselves are looking at other indicators, as I mentioned, involving a few different points of data to measure on IRR. But that's where I think DPI comes in, is that just basis of saying truly how much capital have you returned to your LPs, right? And then further, Christian, I think it's really fair to look from a diligence perspective at the managers that you're evaluating as a family office, right? If you're still investing in venture, is how and when are they going to return your capital, right? What are their obligations to return your capital? Because I have also now heard of certain disgruntled, uh, limited partners that have not been given their net return in the form of either a distribution or otherwise following the exits of certain private companies. And instead, their capital is being used, in a variety of ways by the investors. And it's not necessarily something that certain LPs have felt was disclosed properly or transparently when they went to initially deploy in certain managers. And so having that understanding of the obligations of the return, when is your distribution going to occur, how is it going to be calculated, these are really traditional diligence questions, but I would say in today's environment it's even more heightened to ensure you understand that as a family office if you're deploying into a new manager.
Getting very clear and getting very concise on that, and that's kind of what's top of mind, which is interesting. I got to do a little bit more research on the DPI structure. That's the first time I've ever heard where that's been kind of a focus point, which does make sense though when you're talking just kind of the macro and kind of just the sentiment of what's going on in the industry. When you're looking, because I was talking to another investor friend, and in this area, there's a ton of companies that are that, unicorn status pre-IPO company that haven't went IPO and so forth. And so there's tons. And though it doesn't mean that these individuals are deploying capital in each one. So I was talking to another investor and they look at probably 50. And there are a lot of times
Mhm.
they're on the cap table, bigger checks and so forth. Out of the 50 though, they underwrite. Only maybe 12 do they actually deploy, and they actually kind of pass it to the LPs and so forth. And so I want to ask you in regards to, because you just mentioned, not only are you
Mhm.
optimizing for DPI, IRR, but there's
Mhm.
other data things that you're looking at to make sure when you're co-investing, you're deploying your own balance sheet and so forth. So what other data points are you looking at holistically? Because it is tough when you look at, okay, you got a year over year growth, but the valuation drastically decreased. And we're seeing just some of these companies, the metrics may not be as sexy as they were even just 18 months or 22 months ago and so forth. But you have to
Mhm.
look at the contextual story and what that data is telling you to say, okay, well, what are the projections in the next 2 to 3 years? And can we, obviously, like you mentioned, hey, can we come in at a good price to make sure that we are getting the alpha that obviously justifies the deployment of capital? So I want you to just kind of unpack a little bit the way you guys think about it as a very curated, structured investment thesis to ensure that you're mitigating the risk on the back end for yourself as well as for your LPs.
Absolutely. So I'll tell you this, right? What is really to me exciting about growth and late stage investing is how much of the story, right, matters at this point relative to the current macro environment and then public market as it relates to those comparable businesses that are already out there trading. And I feel for the companies that are still private companies and they really just don't have a strong public market comp. And I'll tell you one thing that I always feel bad about is everyone does their public comps analysis, right? What are the public companies that obviously trade on a relative basis that are they're most comparable to their late stage growth stage startup counterparts. And I always joke that I always feel bad for marketplace companies because there's like 1-800-Flowers that is always this comp for a marketplace company, and it doesn't always do so well. So it's always one of those where marketplace companies kind of get dinged because it's the running joke, at least for us internally, is another 1-800-Flowers comp. But anyway, with that said, here's the thing, Christian. Um, whether you are investing into a private company yourself, right, as a family office, a venture manager, whoever you are, or you're investing through a manager who's then deploying capital on your behalf through either their principal fund that you might be an LP in or through a co-investment vehicle, is do you believe the story of that growth? Right? Do you believe the story and how it's being shared with you, right? Whether it's directly through the company or through the manager providing you access. And when I say that, it's because ultimately, I think everyone in growth and late stage investing has looked to the teams, the management teams of these companies and said, are you being realistic with that forecast going out into the next couple years, right? Because what we're seeing, is the public companies who are reporting, right, quarterly. And if they miss forecast these days across the tech sector by even a few points, they are getting decimated instantly. Decimated. And I mean by, they might miss forecast by 3 to 5%. We just saw this in a few companies that reported earnings this past month or so. And, their stock took massive 20 to 30% swings because of them missing forecast by a few points. And, I would say historically, the private markets have been much more forgiving when it comes to that, right? Because you might change the story. And obviously, we all went through the COVID headwinds, right? And saw our businesses change and our customers' budgets change. So we all had to react accordingly. But if I don't believe the CFO who's telling me, the venture manager, that story of their forecast, I just don't know whether I can, add that into my investment thesis underwriting and say that's a believable forecast. And obviously, our job is to create our own model based on that story as well, which might actually be different than the company's ultimate forecast, right? And that's how every venture manager operates. But is it believable? Is it achievable? And I think one thing that does worry me by way of some of the analysis we've done on some of the AI companies are really big, very, very, how do I put it, aggressive forecasts that I'm seeing out for some of their reporting as part of diligence, where I see AI companies forecasting 3,000, 4,000, 5,000% year over year growth going into the next few years. At the end of the day, that has always worried me. Is that realistic? Is it conservative? But like I said, I think our job as a manager is we build our own forecast, and I think that's what makes it great for family offices who don't deploy in private company assets as their predominant investment strategy. It's one of several strategies as part of broader diversification. And so you have to believe the manager that you're investing alongside to say, are we providing you both the company forecast that we're aware of, or at least we've built, as well as our own, to say, is that actually achievable based on the story of the company, and are they being realistic? Because even though they're still private, what we don't want to see is that they created a story that they can't fulfill. And then, that goes into a next round of funding, and it leads to a down round, right? Or they go public and then it leads to, some unfortunate earnings calls. So that story is so important. And we are storytellers, and we listen to a lot of stories as VCs. And so that's where we have to do a good job of saying, what is actually realistic in today's market.
I think it's so important what you're saying here, Andrea, and I really appreciate kind of unpacking this at a more micro level because, like you mentioned, it's really data driven, data focused, but also what is that data telling you in regards to a story and really navigating it? Because I think it's interesting because we see there's a lot of excitement on certain companies and for good reason. However, though, you don't want to obviously, just deploy capital because it's exciting and it's sexy. You want to make sure you're doing a data-driven focus. And that's why it's important to collaborate with individuals like yourself. And that's why it's so fun to talk about this because like you mentioned, some family offices, it may just be one of their strategies versus obviously you have other different strategies and you got to rely and connect with individuals. Because I noticed this even when you're building and scaling a company, it's like I could look over at a company and one individual may deploy capital and another individual won't. And we're looking at the same data, but that data is telling us drastically different things. So with that being said, because you mentioned, you're seeing some inconsistencies or certain things that are kind of red flags for you in regards to when you're doing due diligence. Definitely when you just mentioned when you're seeing the 3,000 year over year growth kind of projection, you say, okay, let's tone this down. Is there and I know that was kind of like, kind of a probably a kind of a out in the galaxy kind of thing. But I want to ask
Mhm.
you, when you are in those situations, is that an automatic like, okay, whatever, we're going to just ignore that, or is it more of like, okay, we're going to go ahead and let's just assume, and let's kind of put a constraint and say, what if we do, you know, year over year growth 75% or 100%, just so like what do those projections look like on a conservative basis? I'm just curious, like what is as you guys are doing your kind of projections and analysis, how do you
Mhm.
guys think about that? Because I would love to kind of unpack that, because that's what I found so interesting when I'm talking to a lot of people. They have their own kind of blueprints and their own numbers, the way they kind of look at and say, okay, even when they're looking at acquiring a company and say, hey, if we didn't acquire any new any new, and this is more like mid and small cap kind of companies, but if we didn't acquire
Mhm.
new customers, would this company be profitable, and would it be something I want to buy, and so forth, and that kind of mindset helps you understand and put those constraints in. So I want to ask you in regards to kind of putting those constraints in, why you guys are doing your analysis for some of these kind of absurd numbers a little bit.
You know, Ultimately, if a company has really big top line growth expectations, or other, high flying metrics, we are definitely analyzing, of course, the TAM, right? First and foremost is like, is the market even big enough to achieve something of this scale, right? And I think we all will say in the AI world, like there is, such a pasture there for everyone to grow into, but really, is it as big as we're all forecasting, expecting, or are we hopeful for? I'm naturally a bullish person in general, and I would say I sure hope so, right? I think there's AI application that could be addressed across every enterprise, every consumer product across the board. However, do we all really have a true understanding of how big that TAM is to fulfill something as mighty of that level of forecast? And then furthermore, as much as I'm kind of thinking about the deployment of some of these products, of whether it's AI or other software that is enterprise scale, is, I'm really looking at the tenacity, the capability of the sales team, their ability to execute and get out there, their ability to iterate products on an R&D level that is really quick to address and apply to the enterprise, and understanding that, ultimately, enterprise software involves longer sales cycles as a whole. So with that said, it's like, sure, you might have 3% year over year forecasted growth, but do you have a sales, capacity that can fulfill that and be out there and be selling these contracts and signing these contracts and onboarding the customers and then getting them to scale up their contract value by way of consumption or otherwise? And I think generally those are really, really important things to understand, across the businesses that have really strong forecasted growth. And then, Christian, as you said, if you're talking about mid-market companies per se who might be doing growth by acquisition, well, how long is that integration going to take to integrate the acquired asset, the acquired companies or acquired customers, get them scaled up to full capacity, and then actually start generating meaningful additional revenue on that customer base, by way of that asset? And like, those are very, very important questions that, once again, it really goes back to the story being told by the company, by the issuer. And are you painting a picture that is a realistic thing that can, jet out and become a success?
That makes sense. And when you're looking also at this, because obviously there's not as much capital in the private market, it doesn't mean that there's not going to be, obviously, we're going to see an uptick a little bit. But right now, holistically, and one of the reasons why a lot of companies have stayed private is because there's been a massive amount of private capital in this industry, which obviously has elongated the IPO structure, which is kind of why we're in this situation. My question is, when you're looking at these companies, are you looking at, kind of, okay, are we cash flow positive? Is that a factor? What's our burn rate? What's also kind of, what's our runway a little bit? Because when you're looking at these companies, I'm noticing definitely when I've talked to international companies, companies that don't have, like Europe or whatever, they don't have as much of as a big LP base, if you will, so they can
Hmm.
burn cash. They have to build a very efficient business and make sure that they are profitable to reinvest back in the business, because they can't rely on too much on outside capital on a consistent basis.
Hmm.
Here in the US, we're slightly different, where we've seen these amazing ecosystems where you can burn the shit out of money and just keep acquiring market share and so forth. So I just want to ask you,
Hmm.
when you're looking at these companies at this stage, because we have seen kind of evaluation, it's been kind of all over the place, a decrease in valuation, I should say, but all over the place. But we're also seeing certain companies really hitting a massive supply and demand issue, where SpaceX and Stripe, and obviously some other companies that are like, oh, this is sexy, and you're actually seeing the price of those drastically increase. I shouldn't say drastically, but you're seeing there's a little bit of premium on there. So I was just curious, when you're looking at that, are those factors in your analysis?
Absolutely, absolutely. And I would say, it's funny you mentioned SpaceX because that is a well-oiled, rocket ship, machine, obviously. With that said, I think SpaceX is a little bit of an outlier. Obviously,
Hmm.
it's actually a tremendously profitable business when it comes to their EBITDA positivity. And clearly, what I think, SpaceX has always done in a strong way is say, what is our lever, our anchor revenue generator, which very much so has been their Starlink product, and then that fuels their ability to keep funding launches, at scale, right? And I would say generally, that creates such a positive momentum, and everyone has that really inherent Elon premium, right, baked in there as well for a business of that nature. And so I definitely put them on a bit of a different scale. But if I'm looking at, companies like Stripe and similar businesses that have really had to continue spending a lot of money for growth, right? That is a strong flywheel. And at the end of the day, a lot of these companies are assessing, how do we reduce our cost of capital, and how do we reduce spend across the board, so that there are certain infrastructure needs that they have that they were trying to reduce, right? And as we see it in, companies that are building in the AI space, right? They're looking at it and saying, oh my goodness, the cost of chips, the cost of,
Hmm.
AWS, the cost of compute, very expensive. How do we reduce those costs? Because those are hard costs on infrastructure that, are, increasingly going up as a way to continue growth. And so we are evaluating whether the market is willing to still pay for growth, or are we paying for profitability? And then the question is, are you too profitable to the extent that, quite frankly, it doesn't excite your investor base, because they say, listen, now you're too profitable, you're not growing enough, and your asset just might be not as exciting, once you hit the public markets, right?
Mhm.
And so it is such a delicate balance. And I really look to the finance teams to guide us in our diligence with these issuers to say, are they pulling the right levers for the story that they're going to need to tell as a public company to keep the public market excited,
Mhm.
right? And if they're not, then I think that's where they could take a hit. But again, that's where if they miss those projections, right, that's where they see like that can turn into a pretty big detriment to a share price. So I think it's a really delicate balance, and the levers of pulling profitability and spend are something that I just have to believe a company's able to do, so that if they need to swing one way or another to achieve the right balance relative to their counterparts, that's where I'm looking for the strength.
Incredible, incredible. And I love what you said in regards to, definitely in the AI world where you've got a lot of OpEx kind of, structure, right? It costs a lot to be able to run that. However, though, what does that projection look like in regards to profitability kind of timeline? And then also, like you mentioned, I think SpaceX is an outlier. So let's just kind of stick with all the other companies out there and just kind of structuring that and what you guys are looking at. Um, I think it's just an interesting kind of balance what you were talking about. Where are we profitable, but also do we want to grow and acquire that total addressable market like you mentioned later on. We mentioned this offline, and I want to bring this up because it is interesting. The VC world, the macro, the scary environment right there. And I really want to get your perspective because we were talking a little bit of mitigating risk in the VC world. A lot of family offices, we've also got pension, endowments. They're kind of, walking away from that industry just a little bit and kind of reallocating their portfolio. And we've talked a little bit about this, and I've talked with other investors as well. I want to get your kind of just, what are you seeing in regards to trend, and how are you seeing a lot of these investors are starting to restructure their wealth? Because again, I know we're not going to talk about private credit and things like that, but that's kind of a big thing for a lot of individuals. What can be a good return, very secure, and hey, it's rocking and rolling. So I want to ask you specifically about VC and the macro scary environment around that.
Sure, sure. So just briefly on it too, right? Is I think venture managers, especially those of us who, of course, like I said, including Manhattan Venture Partners in this, we're assessing, how do we build our platform, right, to consider asset allocation strategies that might not just be traditional VC, and it's something where you can provide a diversified product base to your investors because, as you said, many of them are seeking diversified returns and certainly different level of securitization as it relates to those returns and those assets. And so generally, I think many venture managers who have the platform to be able to do so are looking at other product lines to consider offering. And it really is by way of the need, the ask being asked of our LPs to say, what else do you have to offer? Right. We've got exposure with you in venture. Is there exposure you can bring in other forms of private alternative assets that are different, have different levels of risk strategy associated with them. So I think what I see interesting, and it's something we're exploring at MVP as well, is by way of our platform is how do we bring out other forms of tax efficient structures to our LP base for them to consider allocating some of their dollars towards or moving some of their assets into, as well as how do you provide them access to products that are potentially tied to venture but might suit them in other ways, so they're either cash generating dividend products, income generating dividend products, or something similar. And I think those of us who have, like I said, the platform to be able to offer that in venture are the ones who could build just deeper relationships with our LP base, because now we have a platter to say, here's what we can do, and venture will always be our core thesis, but there are other offerings that are adjunct to venture that can best suit an overall diversified portfolio base. And then hopefully, obviously, at the end of the day, is you're returning capital in a variety of ways to your LP base. And then what they're doing is obviously hoping to reinvest that with you. And it just builds a much deeper tie overall to those capital bases. And so I think that's where it's really interesting to see venture managers bridge out and really develop banking platforms, wealth platforms, asset management platforms. And it's something we're spending a lot of time with brewing at MVP. So I think generally it's a really interesting time where if you have the capability, the resources to go beyond venture as something to offer further products to your LPs, now is definitely the time to consider doing so.
And let me ask you in regard to this, because this is interesting you're mentioning this. It's kind of outside of the private market industry, but you're also adding all these other kind of wealth alternatives. And the reason why I think this is interesting, because if you talk to any wealth manager, the way they're structured is anything in-house that they manage, they get a fee associated with it. But a lot
Hmm.
of times I've actually talked to a lot of wealth managers, and they may have a lot of doctors that may be interested in the private markets, but they're not incentivized to connect and collaborate and give this kind of and channel this down to a lot of their clients, mainly because anything outside of their kind of AUM assets in their house, they don't get compensated on it. So it's like the incentive
Hmm.
is just slightly off. And then you just got to know the wealth game. Like you just got to know the wealth manager game. There's nothing wrong with it. It's just, it is what it is. And you got to incentivize. So what you're saying is you're aligning your incentive with your investors to make sure, hey, you know what? Not only are we bringing amazing deal flow, but we're also bringing all these
Hmm.
other added services as well to make sure that there's this beautiful integration between. Is that correct in the way you're thinking about it?
That's right, exactly.
Okay, that's actually very exciting. What's that trajectory look like? Are there certain things that's, like you're noticing in regards to like certain products and services that are top of mind mostly, or is it more of just kind of like simple wealth management stuff? I'm curious
I would say,
because there's levels to it. There's
generally.
levels to it.
Oh, absolutely. And I would say there's a lot of folks in the industry, right, that if you look at this, I don't think I generally see most people in venture trying to cross over to fully taking on full bore wealth management, right? Because I think wealth management as a function is, as you said, it is a big strategy around asset allocation, diversification, and then pointing that capital base towards those various assets and really being responsible for that capital deployment. I would say various forms of tax efficient structures, jurisdictional structures, also just income generating structures, both between the sides of how venture sees an asset, but also further kind of fueling the growth of these companies, right? So I would say, you've got a lot of companies these days who really need to fuel purchase orders, right, for inventory and purchase orders for merchandise. And how can you better align with companies if you have the capability to do so as a venture manager to say, hey, listen, we see your commitment to your customer base and the contracts you need to fulfill. Let's strike some sort of balance around venture as well as some form of ability to fuel you for your growth, right, in other ways. And I think that's where tapping your LP base to see whether they're interested in exploring various forms of structure that better support these companies, right, better support the companies that are really still trying to grow and they want to remain capital efficient, and you might have the ability to do so as a venture manager by tapping into your LP base, right? And I would say those are the kinds of things that we're spending a lot of time with exploring. Certainly, like I said, not our predominant business. It will always be to be venture managers that look for equity opportunities. But at the end of the day, there are plenty of companies out there that are still trying so hard to use their capital efficiency. And at the end of the day, if you are one of those investors that could better help them, both from just writing an equity check into a round, but then also helping them structure the ability to fuel their growth in other ways, I think that is being a true value added investor in today's market.
100%, 100%. Looping back a little bit on VC as well, I've noticed a lot of individuals are, and me specifically as well, I'm always one of these. The way I think about the VC ecosystem is a lot of times it's a kind of a spray and pray approach, right? It's a quantity game a little bit. I understand that small checks and a lot, and then hopefully out of those, about 80% won't produce anything. 20% obviously will offset the VC industry and so forth. And so one of the things I found interesting is what I always love to do is more of a debt to equity play, mainly because that
Hmm.
mitigates the risk. Definitely if it's like pre-rev or so forth. But if they're revenue positive, then I can do proper due diligence and underwriting for both not only the team, but also kind of the company and the projections. But also at Series A, which I always find interesting because now you also have a lot of top line revenue, you have momentum, you have a team established, and there's just a better projections and so forth mitigating if I'm going to deploy capital for an equity play. And
Hmm.
what I've noticed is I think what's interesting is a lot of family offices and high net worth individuals, it's like they still want to play in the VC world, but it's like they're just being more more what's the word, more strategic and tactical, and saying, okay, hey, what are we going to do to mitigate that risk, to ensure that we're not structuring. I've also noticed where they're doing a lot of co-investing to make sure and
Hmm.
say, hey, instead of going out there and doing the in the fund approach, I'm going to take more of a control aspect on it. And like you just mentioned as well earlier on in this conversation, where they're taking an operational role. Definitely, if you
Hmm.
have the in-house ability and so forth. What are you noticing as well? Just making sure like they still do want to play in it, but they're just kind of their tactic and their strategy around the VC world specifically is adjusting and changing and evolving.
It is. It is. No, it absolutely is, Christian. It is. It has been evolving, and of course, it really depends, right, on the circumstances of that ultimate investor, the LP, the family offices. Like, where do their strengths lie,
Mhm.
right? Is it being more involved? Is it being involved in some sort of tactical way? I mean, and obviously, what makes late stage venture quite different than early stage venture is the level of involvement you might have with the company, simply because they say, listen, at the end of the day, some of these later stage companies are such well-oiled, fairly sizable machines that it's like you don't want to be too intrusive. You want to be helpful, but you want to be there for them for the right opportunities. In the earlier stage, you definitely have that opportunity to roll your sleeves up and get much more involved. And so I think I definitely am seeing that it's all this kind of approach in terms of how many companies you're investing in your portfolio on an ongoing basis. The bigger the fund, the more capital they have to deploy, the more they might be likely to take more of a spray and pray approach versus those of us who might have more concentrated smaller funds where we take a more dedicated, shorter, I would say, shorter, horizon towards an exit. And we're looking to deploy capital maybe slightly more slowly than those of us who have the bigger massive funds that come in with the billions of dollars behind them and need to take really small positions across the board for diversification. So it really is a question of, if you're an LP, if you're a family office and you're evaluating, is saying what level of involvement, right, as you said, are these venture managers going to have with the company? So therefore, what level of story and relationship are they going to have with the underlying issuer? And then making that decision of what your comfortability is with that relationship on an ongoing basis. And is it a value add relationship between the issuer and that private investor? And it's something we're very, very, very sincere about at MVP. So I think, that is something that every LP should be questioning today, as you said. Being more tactical absolutely makes sense. And overall, just making sure that you have the trust of the private company to be able to lean on you in times of good and times of bad. And if they really need something, feel comfortable enough to reach out to you as an investor and say, hey, listen, we got something going on. We're in a pinch. We need your help. So pretty big level of relationship diligence you could really do as an LP.
And you keep coming back to this main word, and I love what you're saying, relationship, right? In this industry, it's a matter
Hmm.
of really working with the right people that know what the hell they're doing and be able to
Hmm.
facilitate amazing relationship. Because, like you just mentioned, every deal, depending upon obviously what equity vertical you are focusing on, whether it's VC, PE, or whether it's a secondary market pre-IPO companies, you got to make sure that you're working with individuals that know how to navigate that, because every situation is very contextual. And I
Hmm.
appreciate this conversation, Andrea, unpacking what MVP has been able to do and what you guys are doing with your 600 LPs and family offices all over the world. And not only just on the private markets, but also kind of the other services that you guys are bringing in. I'd love to talk a little bit about that, maybe on another podcast, talking about kind of the services that you have had to be able to integrate that kind of beautiful relationship between both, for the holistic approach and resources for your LPs. For those that want to reach out to you, Andrea, and just want to learn a little bit more about what you got going on. I know you speak a lot of places, and understand what MVP is more about. How do they reach out to you, Andrea?
There's a few ways outside of just a bat signal. No, I'm just kidding. Of course, always reachable. I would say everyone could shoot me a note. A Waln, I'll provide that to you, Christian, after this podcast. But A Waln at MVP.vc would be great. They could do it there. Overall, too, if you shoot an email to us at info@mvp.vc, that's always going to be routed to the right person. But overall, I think we're generally easy to reach. We're on all the social platforms. We do a lot of media and marketing. So, if you reach out to us through any one of the, LinkedIn's and otherwise opportunities, you will reach someone within the team to be directed to the right people. So hopefully we're quite approachable. We'd love to hear from everyone and get together with folks that are across the US and otherwise.
Definitely. And guys, just make it very simple. I'll put all those links in the description, her LinkedIn, her Twitter, her email, as well as her website there. And guys, Andrea, I really appreciate being on here, just sharing your incredible wisdom. We should have you on again in Q1 and Q2 of next year because this whole economy is definitely always evolving, and it's always fun to talk about this. Guys, that is the general partner at Manhattan Venture Partners, the one and only Andrea Lamari. Guys, that is Journey with Christian Evans podcast. Until next time, be uncommon if you can. Andrea, thank you so much. That was a lot of fun. How'd you feel, huh?
I loved it. You know what? I think this was. I'm gonna be really honest with you. I think Christian, you did like the most homework of anyone in terms of, and not even just homework, like your basis of obviously who you've worked with in the past and your experience yourself is like really it like showed through so much, and that's why when you initially reached out, I was very quick to be like, oh yeah, this guy knows exactly like the world that we all live in. So I really appreciate that
Well,
background.
thank you so much for bringing it up because you were mentioning some really interesting things that I'm going to have to do some homework on like DPI. I'm sitting there going like, oh shit, I don't know
Oh
what
my
this
God.
is, so I got to figure this out, But this, I just love
Yeah.
the stories you shared, also just kind of the wisdom that you brought in, and obviously you've been in this industry for a while because I know that you're kicking butt. You kicking butt. You play to win, aren't you? Play to win.
Can't wait. We all are, right? Well, that'll be next week too. Except I'm like, even though I'm not good at golf, I'll be there.
Uh
I'll be
oh.
there.
Uh
I'll be there. Yeah, yeah. I'm excited. And then yeah, like I said, so like we know the guys at Empros and a couple of the other folks that you had mentioned. So I'm like very excited to catch up with you in person.
oh. Yeah.
Really
I don't know
appreciate
if
you
I
inviting
sent you
us.
the whole list of the actual guests. So we have actually 50
Would
people.
love you.
And
Oh, would love
yeah,
to.
so it went up quite a bit. But yeah, I should send you the guest list and their LinkedIn so you can get some context of who's all going to be there because it's gonna be a lot of fun. We've got some amazing
Yeah.
investors and talking about all sorts of things, specifically in the impact investing because Sal, he's in
Awesome.
the life sciences world, but we've got some investors as well that kind of focus on just all sorts of different verticals. Obviously, space, space is really big,
Hmm.
exploration, stripe, and whatever. But this is gonna be fun. Let me know if you guys
Yeah.
are in town because I always love to grab dinner. I know we're gonna
Yeah.
obviously, have the whole networking and dinner and stuff
Yeah.
like that. But if you guys are in town
Yeah.
longer, I don't know if you play
I-
tennis, but Mayfan and I, we're gonna
Yes.
be playing. Oh, you guys do play tennis? Okay.
We do play tennis. Yeah. Yeah.
Oh,
I love tennis.
okay.
Yep.
Maybe
Yep.
a
Yep.
2v2 sometime, maybe, huh? Saturday
That'd be
morning or
cool.
so. Okay,
Yeah.
okay.
And you know what, Christian, as well. I don't know if you've already put it together, but just kind of offering this because I have definitely analysts who do this stuff all day. So even if you send me the guest list and if you want my analysts at all to like go through add a like a do a Google sheet or something that adds like their LinkedIn and their bio or something that then you could share with other people. I don't know if you've already done that exercise, but if you want to tap my analysts who are just kind of sitting there waiting for projects, I got a few of them who would happily take this on if it's at all
I
helpful.
appreciate
So
that. I appreciate I've actually had my team
yeah.
do it, so I will actually send you that.
Okay.
But obviously, feel free to send it to your partner as well. So then, obviously, you
Yeah.
guys get some context. Because I always love to know who's going to be at the event, so then I can just vibe off what they got going on. And one guy
Mhm.
we've got, he's Fabrizio. He's actually in New York. He's a friend of mine, and he does rally racing. So we're going to be talking about the F. Oh, by the way. So we're not only this event, but we're doing another event for the F1 in Miami Grand Prix.
Okay.
So
Yep.
that just wait. We'll see what we can do for that, but that's upcoming.
That was in May, right? Or that's usually in
That's
May.
in May, early May. Yeah. So
Yep. Yep.
we're in
Yep.
talks with that. So we may do another
If
thing for that. So
I'll let you know this, which is probably really cute. So my after I went through my separation with my ex-husband a couple years ago, that I actually met Steven, my partner
mhm.
who's joining me for the trip. I met him by way of a family office event in Miami at the F1. So
Oh, good
that's how
good
we met.
memories, huh?
Yeah, yeah, yeah. So we have good memories of F1 in Miami. There's clearly good luck over there. So if that's something you're exploring, that'd be great. And yeah, he'll tell you about some of the stuff he does. I mean, you'll obviously meet him and all the
Mhm.
clearly all in the gist of all the multifamily office strategy stuff. So I think it'll be really good. We're super excited to join you guys.
Awesome, awesome. I'm looking forward to it as well. You got my
Yeah,
cell phone, so feel
yeah,
free. But other than
yes.
that, Andrea, you have a wonderful Thanksgiving, wonderful week, and I'll
Thank
see you
you.
next week.
Yep.
Sounds cool?
Amazing. And so when are you just because I think my team, my market, we have amazing, marketing team. I'm very humbled by. When do you I'll tell them to look out for this, but in terms of how you edit and put this together, what do you think is the traditional timeline? Because I think for this segment, I'm gonna want to do the following. I'm gonna want them to like my team to go in there, splice that up and be like question, answer, and then we kind of use those through
Yes,
our social channels.
yes. Mhm.
And so I'll tell them to kind of get ready for that on the
So
docket.
normally it's a 2.5 month, but because with the conversation we've had is very timely information. So what I'd like to do is I'm going to probably put it up, and probably mid-December is when we'll deploy it,
Okay.
right around Christmas time or prior to Christmas, because that's when people are listening to
Okay.
podcasts and stuff like that. And then my whole
Mhm.
team will send you a Google folder of the video assets, audio assets, video snippets, all that professional stuff. And then we'll give you the raw file as
Amazing.
well in case your team wants to kind of
Cool.
snip it up. Cool?
Sure. Amazing. Amazing. And we'll share.
You got it. Of course, of course. Have a good one. Appreciate it. You got it. You got it. Cheers.